So I think we're live and recording, right?
Yes, we're live. So good evening, everyone, again. Welcome to the second session of the winter school for today. And I'm happy to kick off the Resilient Markets and Decentralized Finance session. It's a pleasure to introduce its moderator, Anna Obizhaeva. And Anna is a professor of finance and head of the Master in Finance program at the New Economic School in Moscow. And basically, the New Economic School is our partner for this conference, and we are very happy to have them helping us with the broadcasting and in general. And actually, Anna, before joining the New Economic School, she was an assistant professor of finance at the University of Maryland in the United States from 2007 till 2014, and completed her PhD in the Massachusetts Institute of Technology. And so I'm happy to welcome Anna and Perm School virtually again.
Sergey, thanks a lot. And I'm glad to welcome everybody to the third session of the Perm Winter School. My name is Anna Obizhaeva, and I'm professor of finance at the New Economic School. And this session will be on topics related to trading, and in particular on how to design robust mechanisms that will be underlying trading and all of the related processes of clearing and settlement and other things. We have very good speakers today who come from very different backgrounds, I would say. Some of our speakers are more from engineering, physics, sort of techy background, and we also have speakers who are financial economists. So our first speaker will be Pete Kyle, and I'm especially pleased to introduce Pete. Pete is a leading expert in market microstructure, and there is literally hardly anybody in the world who knows more about liquidity and trading, as well as many other topics in finance. Pete is chaired professor of finance at the University of Maryland, where I used to work myself. And he completed his PhD in economics at the University of Chicago, and then worked at Princeton and Berkeley and Duke University. So Pete wrote a number of very influential papers in finance. But I guess for broad audience, he's known for Kyle's Lambda, the measure of market depth, which comes from one of his very famous papers that he wrote in 1985. So we have been, I'll maybe disclose the secret that we have been trying to invite Pete for many years to Perm Winter School in the past, but it was a very long flight from Washington, D.C. to Perm. And so this year, thanks to COVID, we're online, and so we're very fortunate to have Pete today with us. So Pete will talk about his ideas on how to improve modern trading systems. And I would say that this will be quite different from ideas that have been discussed so far. But I believe, and will be discussed in the future in this conference, I believe. But I think it will be very useful for many of you to get a sense of how finance economists think about these issues. So Pete, I would give this floor to you, and you'll have like about 1 hour or so to talk about your paper.
Okay, well, Anna, thank you very much. I think I'm going to share my screen immediately. You should be seeing a screen here that says flow trading.
Yes.
And the paper that I want to present is called flow trading. This is not my typical paper. This paper is rather non-mathematical by my standards, and it's a paper about a practical problem. It fits into the overall area that we call market design. And I think market design could be a kind of unifying theme that this conference is about, including cryptography as well as finance. Well, this paper is got a very large number of co-authors. Eric Budish is a professor at the University of Chicago. The other 4 co-authors all have connections with the University of Maryland. Peter Crampton is at the University of Cologne, but he was at the University of Maryland a couple of years ago and had been there for many years. I'm at the University of Maryland. Mina Lee is an assistant professor at Washington University in St. Louis, but she was a PhD student at the University of Maryland. And David Malik has got an appointment at the University of Maryland. So big University of Maryland connection. And I should just say, many people don't know where the University of Maryland is, but the answer is it's less than 10 miles from the White House. It's in College Park, Maryland, but it's a very close suburb to downtown Washington, D.C. And I'm able to present here at this conference today, even though I'm in the middle of a very heavy teaching schedule because COVID has kind of shut things down. So let me provide a disclaimer here. Peter Crampton was, until recently, an independent director at ERCOT, the Texas Electricity System Operator. It slowed down the progress on our paper because it got cold in Texas. And he's also an academic advisor to a private equity marketplace, CartaX. And I'm an independent director of a US-based asset management company which trades global equities. But everything we're talking about here is our own ideas, not the ideas of these other entities. Our research is sponsored by our academic salaries. So what we are doing in this paper is proposing a new design for how to trade equities. And it requires a different way of thinking about how investors interact with the marketplace. So I'm going to begin by talking about how current exchanges operate in 4 bullet points. First of all, in current exchanges, traders use mostly standard limit orders, which say something like buy 1,000 shares of Apple at a limit price of $126.85 per share or better. What this means is that if the price is less than $126.85, you expect to have bought 1,000 shares at a price no worse than that limit price. If the price is above the limit price, you don't expect to buy anything. And if the price is equal to the limit price, there's a problem because you don't know what to expect to have happened with your order. It might have been partially filled, none of it had filled, all of it filled. Typically in current exchanges, orders are for individual assets, not portfolios. The way exchanges trade portfolios is through ETFs, exchange traded funds, which can be thought of as portfolios of assets. Orders tend to be processed one at a time continuously. People call this a continuous limit order book. I don't like that terminology, but what it means is that when an order arrives at the exchange looks at the limit order book of resting orders, the orders that haven't been executed yet, and tries to execute the incoming order. If they can execute it in whole or in part, then it's wholly or partially executable. But if they cannot execute it because the prices are not good enough, then that order will be entered into the limit order book and it will become a resting order waiting for the next order to arrive. In current markets, you also have displayed bids and offers that respect what we call a minimum tick size. In the United States, it's typically 1 cent per share for almost all stocks. I know in Moscow, the tick size changes over time, much more than in other countries, which I think is a rational way to manage tick size. And also in the United States, quantities are traded in round lots of 100 shares, or at least the quotes are in round lots of 100 shares. And that creates a lot of trades in round lots of 100 shares. So these are all institutional features that exist in current markets today. Now, what motivates our paper is that this design creates some costs or impediments or inefficiencies in the actual operation of markets by making it excessively costly and excessively complicated for traders to implement the types of trading strategies they would like to implement. So the first problem is that orders are subject to essentially immediate execution risk. And this means that if the market price or the fundamental value of the asset suddenly changes by a large amount or a small amount, fast traders, that we often call high frequency traders, will enter orders to quickly pick off the resting orders in the limit order book. And that means they will trade against those resting orders at what we call stale prices. Those were decent prices a second ago or a fraction of a second ago, but they are bad prices for the resting order when it is picked off, good for the high frequency trader. And this imposes a cost on having resting orders sitting in the limit order book. So what do institutional traders do? They typically spread their trading out over time, and that results in the institutional traders placing and canceling thousands of small orders. But this requires a huge amount of bandwidth, a lot of resources to manage the complexity that results from having to keep track of so many small orders. Now, arbitrage between assets, we'll call it pairs trades in this paper, would be trading one asset against another. So for example, Berkshire Hathaway has two types of shares outstanding, A shares and B shares. They trade in fixed proportions. So one share should be worth a given fraction of the other. Arbitrage between the two takes place, but you need to constantly adjust the bid and the ask prices of both assets by changing the price at which you're willing to buy one and changing the price at which you're willing to buy the other as prices change. So simple arbitrage strategies that are designed to keep prices aligned result in the placement and cancellation of thousands of orders. And this is inefficient because it uses a lot of bandwidth and requires a lot of messages that need to be processed. And then finally, this discrete tick size, that's a feature of the current design, induces queuing and racing for what we call time priority. If two orders arrive into the market at approximately the same time, time priority means the one that arrives earlier gets executed first. And this is important if you have a fixed tick size because the execution price might be good for the resting order that gets executed first. So if you have a bigger tick size, it widens the spread and makes it even better for the resting order. And it induces even more racing to be the first in line. And of course, many investors lose that race because winning it requires investing a lot in technology. We call that the arms race for speed, but that's an inefficient zero-sum game arms race for speed that we want to eliminate. So what is this paper about? Well, this paper is a combination of 4 ideas. In the written version we're working on, it's actually going to be 3 ideas because we're going to collapse the first 2 together. But it's 4 ideas. The first idea is that everyone submits a piecewise linear downward sloping demand curve that essentially defines a demand schedule that's a continuous in both price and quantity. So this means that we need to allow essentially microscopic variations in the price, not 1 cent, but maybe 1/1000th of a cent or a millionth of a dollar, and also continuous variations in quantity, not shares, but fractions of shares, maybe nano shares or some tiny fractions of shares. We implement supply curves. If you're an economist, you know that demand curves slope downward and supply curves slope upward. But we're going to think of supply curves as demand curves for negative quantities. And the negative quantities then are quantities supplied. So everything is a downward sloping demand curve. The second major point is that we have flow orders. So what a flow order is, and I'll describe it in detail later, it specifies a maximum rate at which you're willing to trade. So instead of submitting an order that says buy 1,000 shares now, you submit an order that says buy 1,000 shares over time, but at a speed no more than, say, 1 share per second. The third bullet point here is frequent batch auctions. So rather than process each order one at a time as it arrives in the market, we wait and process orders once every second. And then you might be processing a large number of new and old orders simultaneously, calculating auctions at which prices are established. And then the fourth element of our proposal is orders for portfolios. And we define a portfolio as a linear combination of assets. So you can submit an order to trade an entire linear combination of assets that specifies a downward sloping piecewise linear demand schedule for that portfolio. And then the rate of trading at which you buy that portfolio depends on the price of the portfolio, which is calculated from the market clearing prices of the underlying assets. So these four ingredients are the elements in our design. So this design has some benefits because it's a language for expressing preferences that makes the market function more efficiently by eliminating some costs that traders currently incur when they do trading. So the first advantage is that it reduces the costs or the risks of resting limit orders being picked off. As I discussed previously, if you have an order for Apple stock to buy 1,000 shares sitting in the market, and suddenly the price drops because of an earnings announcement or something like that, a high frequency trader will pick off your order and you'll lose maybe a few cents or a dollar on 1,000 shares. But if you're executing your order gradually over time at a speed of like 1 share per second, even if you spend a whole second canceling your order, which is a long time in today's markets, you only trade 1 share, not 1,000 shares. So it reduces the cost of being picked off by a factor of 1,000 if it takes you 1 second to cancel your order. If it takes you a few milliseconds to cancel your order, it costs you virtually nothing when a high frequency trader tries to pick you off. It allows traders, the second bullet point is it allows traders to trade gradually with just one order. So for example, in today's markets, we have what's called VWAP trading or TWAP trading, volume weighted average price or time weighted average price. You can match the volume weighted average, the time weighted average price exactly using our approach with just one order. But in today's markets, it requires a complicated, high bandwidth, costly infrastructure to do this. Third, it makes it easier to implement these pairs trade orders and portfolio orders because a pairs trade order can be implemented as just one order for a portfolio that consists of a long position in one stock and a short position in the other. In other words, you're buying one stock and selling the other at a fixed ratio of shares. You just submit one limit order to buy that portfolio as a function of the price of the portfolio. And as the shares go up and down together, you do not have to place and cancel lots of orders. Similarly, if you were arbitraging a basket of stocks against the S&P 500, you could have it one order that would buy the entire basket of S&P 500 stocks, buy 500 different stocks and sell the, let's say an ETF that was holding that basket of stocks. The fourth point is that it eliminates frictions associated with minimum tick size because we really effectively do not have a minimum tick size. We reduce it to such a small quantity that it doesn't matter anymore. And that means that all of these games that have to do with timing and racing associated with the minimum tick size are unnecessary to be played. So we think that flow trading, the combination of these four ideas on the previous slide, is a language for implementing strategies that are nearly optimal in the game that traders are actually playing. Now, this is, so our objective here, if you think about what is our contribution is not exactly a technical contribution, although there's some technical details I'm going to talk about, but it's a practical design contribution where we think that this design actually fits well with the way traders want to use markets. And it's fairly straightforward to implement so that if markets implemented it, it would make participation in the market more straightforward and more efficient for the players who want to trade. More efficient here means the costs of actually interfacing with the market are lower due to the arms race for speed, not motivating traders to spend huge amounts of on wasteful resources on speed, and also huge amounts of economically wasteful resources on bandwidth. So it's kind of operational efficiency that we are trying to improve. We're not trying to do what other economists might think is interesting, and is interesting, which is to correct what are called market failures that are related to monopoly power or private information. That would be a different research design that says, let's redesign the trading game to distort what people want to do to fix things that are wrong with markets. We're assuming that markets are trying to do something that is a reasonable objective to pursue, and we want to pursue it as efficiently as possible. So there's a literature on all these issues. The main two papers that are relevant here are first, they're a paper by Budish, Crampton, and Shim. They propose frequent batch auctions as a way to deal with the arms race for speed and eliminate the incentives that high frequency traders have to incur costs to play a kind of zero-sum game with everybody else. And then the other paper is a paper of my own with Mina Lee, where we propose piecewise linear downward sloping demand schedules for individual stocks. And we also propose flow orders for the individual stocks. So what we're doing is combining frequent batch auctions with flow trading and piecewise linear schedules. And that's combining these two papers. And then we're adding to that the idea of trading portfolios at the same time. Okay, so there's some other literature that's relevant to this. And as far as background goes, there's my paper with Anton Obizhaeva, who's here, and Yajun Wang, both of whom were assistant professors at University of Maryland when we started writing this paper. And this paper is about smooth trading. But obviously smooth trading and flow trading kind of refer to the same thing. And what we do in this paper is we construct a kind of equilibrium model of trading in which traders collect private information and then trade dynamically on that private information, taking into account their market impact. And the resulting equilibrium is like a it's like a competitive rational expectations equilibrium, except there are two differences. One is it's not competitive. The traders are strategic. They realize they affect prices and they therefore trade less aggressively to minimize price impact. And the second difference is that the traders are almost, but not quite rational. They're slightly overconfident. And the overconfidence makes them trade more aggressively. But when you combine those two elements together, what do you get? You get an equilibrium in which all of the traders trade as flows, and they submit demand schedules that look just like our flow demand schedules. And so you get an equilibrium that looks exactly like what we're trying to implement with this flow trading idea. Not only that, we assume that there is exponential utility and normally distributed random variables in the paper. That makes the trading strategies linear. And so you could, as long as your information didn't change, you could implement your optimal trading strategy on our paper with one flow trading order. You would then update it whenever you got new information, and the price would change because you have price impact, and that's the way prices reveal the information to the market. There are also a couple of other papers that are similar to ours. There's a paper by Vianos in 1999 and Du and Zhu. They also have something that looks like flow trading, but they set up their models in discrete time, not in continuous time. And also they have more of a hedging motive of trading rather than a speculative motive. But otherwise, it's all the same idea that traders want to trade like flow trading, and the equilibrium looks like flow trading. So let's implement it as flow trading. Okay, there's another literature on sophisticated expression of preferences over multiple objects. This is like the auction or market design literature. And then there's, in addition to that, a literature on fixing the welfare breakdowns that financial markets might have. Glattfelder, Rostock, and Yoon talk about this. Duffy and Zhu and Anthony Zhang also have different ideas about this, but I'm not going to go into that here. What we're doing is much more related to what I just talked about. So let me talk about how the orders work in our model. A portfolio is going to be described as a vector of asset weights. So we use the bold W with an I. I refers to the ith order, and the bold W refers to the fact that it's a vector of portfolio weights and not just a single number. So the vector could have just one non-zero component, in which case it's a sparse vector representing an order to buy an asset if that component is positive, or sell the asset if the component is negative. You can also have assets that are either complements or substitutes, that what economists call complements or substitutes. And in our world, assets are substitutes if they have different weights of different signs. So in a pairs trade order, one of the assets has a positive weight, one of the assets has a negative weight, and those assets become substitutes. On the other hand, if all the assets have the same sign, for example, if they all had positive weights, that are proportional to the S&P 500, you would effectively be buying all of the stocks in the S&P 500, and they would be complements. And you could also submit orders to buy and sell simultaneously. There'd be two different orders, but that would be like market making orders. So the first part of the order description is the portfolio. Just like in a standard limit order, it's the name of the stock that you're buying. But then instead of having one limit price, we have two limit prices. So we have an upper limit price for a buy order at which you start buying. Here at the example, it's $50.40. We have a lower limit price at which you stop buying. The order starts fully executing. That's $50.30 in this example. And you would put a negative weight if you were selling and kind of negative signs on the prices to think about selling mathematically. But conceptually, you're just implementing a supply curve. So what does this do? It's going to define a region over which the order executes. And that will be a downward sloping linear region. So effectively, we're defining here a piecewise linear downward sloping demand schedule with one downward sloping component that stretches from $50.30 to $50.40. Well, the order also specifies a maximum execution rate, might be one portfolio unit or per second. So if it's an order for just a share of stock, it would be 1 share per second. And essentially, this is 4 elements. It's the weights, the upper limit price, the lower limit price, and the maximum quantity. This is what is necessary to use as an input to calculate the market clearing price right now. You're going to combine a lot of these orders like this together. But there's other information that goes with the orders too. And the most important one is what we call Q max. That's the total number of shares that you want to buy over time. If auctions are held once per second, your order might execute for 3 or 4 hours, which means more than 10,000 seconds. But over that time, at a rate of 1 share per second, you might fill the order or you might not, depending on whether prices are low enough to execute your buy order. Okay, so the way these orders are set up, they're kind of 3 ranges over which they operate. If the price is above the upper limit price PH, then the order doesn't execute at all. We would say it's non-executable. If the price is below the lower limit PL, then the order executes at the full rate, which is Q, the maximum rate that it's allowed to execute. And if the price is in between PH and PL, the order executes at a rate that is calculated by interpolating linearly. So just drawing a line segment to connect those 2 points, and that determines the rate of execution that's between 0. It's close to 0 if you're near PH, and it's close to Q if you're near PL. So to implement this, we need to think of prices and quantities as being continuous, but in a computer using floating point numbers or even integers that represent fractions, you've got to do some kind of rounding. So we would suggest microdollars, which might be 6 decimal places of a dollar, and nanoshares, which might be 9 decimal places of shares, quantities that are so small in the last increment that no one cares about that, and effectively things are indeed continuous. So we have this flexible but limited language for preference expression. We allow assets to be complements or substitutes. We allow urgency to be expressed by the maximum execution rate. You can calculate an arbitrary downward sloping, continuous, piecewise linear function just by summing a bunch of orders together. And of course, we know that with piecewise linear functions, mathematically, you can approximate any function, or at least if the function's continuous. And therefore, you have a fair amount of generality here. But you can't do anything. You can't make an order a function of, let's say, the price of another asset. And we don't allow orders that represent assets as perfect substitutes. We're thinking about exactly how to describe mathematically what the limits of what you can do here are. So suffice it to say, you can't do everything, but you can specify a very wide range of downward sloping demand schedules in multiple assets simultaneously using the portfolios to achieve what portfolio asset managers would like to achieve. So the math of what I said is that you take your portfolio weights, multiply them, or take the inner product with market prices that, let's say, are market clearing prices, and that gives you a price for the portfolio, PI, And then you plug the PI into a functional form that captures this piecewise linear order that I described previously. That's a function of Q and pH and PL, and it's a function also of the portfolio weights through the PI. And it gives you this function that's described by equation 2 that basically says if the price is above pH, you trade 0. If it's below PL, you trade the portfolio at rate Q. And if it's in between, you use linear interpolation. Turns out this trunk function is the same as the probability distribution function for a uniform probability distribution. But the real technical issue we deal with in the paper is market clearing. There's a real question here. Is there a way to clear the markets? And what we want to do is clear the markets not in portfolios, but in the underlying assets themselves. So when you place a portfolio order, you're actually buying a collection of different assets. And so what we would like to do is find a vector of prices, P, such that the market clears. And it clears in the sense that if you take the demand schedule, I call it DI, for portfolio units as a function of the price that you've calculated, so that's DI of P interproduct WI. So it's the demand schedule, demand as a function of the price of the portfolio for the number of portfolio units. Then that's a scalar, multiply it by the vector of portfolio weights. That gives the vector of portfolio, vector of individual asset quantities that you're buying. And we call that bold Q, not to be distinguished from QI, which is a scalar. And what the market wants to do is find prices such that the excess demand, that is the amount by which markets don't clear, is 0. So you want to solve the problem of calculating aggregate demand as a function of prices that clears the markets by adding up to 0 net demand for every asset. And you do that by taking a sum across all the individual orders, I equals 1 to capital I, maybe that's 1 million orders, which you calculate a sum across all the orders to try to do that. And if you find the market clearing price, each order will execute at a rate X that's between 0 and Q for that order, 0 and QI, that's determined by the number of portfolio units that order is demanding. So the question here is, if you have thousands of assets and hundreds of thousands of orders, can the exchange actually computationally find market clearing prices? But before that, we need to answer the question of whether prices actually exist. So I'm going to speed up a little bit because these technical details are probably not important to go through in a huge amount of detail. But the answer to whether market clearing prices exist is that it's very easy if there's just one asset. You have a downward sloping demand schedule, an upward sloping supply schedule. They're continuous. So essentially, they have to intersect. It's possible that they don't, in which case there's 0 trade and perhaps multiple market clearing prices. But it's very easy to just use trial and error or bisection to find the point where supply and demand intersect. What we're going to do mathematically is represent supply as negative demand. So we'll just have one monotonically downward sloping schedule, and it's very easy to find the market clearing price, which on this picture is the net quantity traded is 0 and the price is 45. The trading volume is actually 2 shares per second. But it gets more complicated when you have multiple assets. And so we want to have a theorem that says with multiple assets, the same ideal holds, that there is a market clearing price and market clearing quantities. We would also like to know whether they're unique. It turns out the market clearing prices and quantities do exist, but and the quantities are going to be unique, which is a very important feature of our design. The prices may not be unique, which we think is not an important feature of our design. And then the third question is whether it's computationally feasible to do the calculations to calculate the market clearing prices and quantities that we've proven existed. And the answer there is we think it's computationally feasible, but it's not completely trivial. So we can prove that prices and quantities that clear the market exist by kind of mimicking what economists do with with general equilibrium theory. We can treat orders as expressions of preferences as if they were demands submitted by perfect competitors, even though we know markets are not competitive and they're really strategic. But we're just doing the mathematics, so we can pretend for the mathematical purposes that that's going on. And that means we impute to the order a utility function that may not be the trader's real utility function, but it's a mathematical device that allows us to solve the problem. And then the exchange solves for the problem of maximizing the utility summed across all of the different traders in the market, subject to market clearing constraint, but also subject to constraints that say the order executes the way it's supposed to. And then we can interpret the Lagrange multipliers for the market clearing constraint as a price vector P. So the bold P here represents market clearing prices, but it also represents Lagrange multipliers in a mathematical optimization problem. So without going into the details of the proof, let's think about existence. What turns out that the problem is a very well-known problem in operations research because the way we set it up, we have a quadratic objective. And then we have two types of constraints. We have a market clearing constraint that's a linear equality constraint. And then we have constraints that say you cannot over or underfill the order. It has to be between 0 and Q as the execution rate. Those are inequality constraints, but they're also very simple linear inequality constraints. So what we have is a quadratic objective and linear equality constraints and linear inequality constraints. Well, this is just a typical quadratic optimization problem with linear constraints. It is well studied in the operations research literature. There's actually an active literature about it, new papers coming out even in the 2020 about algorithms for solving these problems. They're very well studied. So it's known that there exist market clearing quantities. How do you prove that? Well, we have a continuous or a concave objective function. We have a compact space of quantities traded because all the orders have to execute at a rate between 0 and Q. It's very important in these optimization problems that no trade be feasible. In other words, something is feasible that clears the market. In our case, no trade is feasible because 0 is an execution rate that's feasible on all orders. And so that clears the market. So this combination of three assumptions guarantees existence of market clearing quantities, but it does not guarantee existence of market clearing prices. So to get market clearing prices, we have to think about the dual problem. And for the dual problem, we find that there's concavity again, there's quadratic again, no trade is still feasible, and there are linear constraints, equality and inequality constraints, and this combination of assumptions actually guarantees the existence of prices. Unlike quantities, the prices are not necessarily unique. There can be a kind of set of prices at which a market clears, but that set is always strictly concave. It may be unbounded. For example, if you only had one order in the market for one asset, obviously it cannot trade with any other order, so the market clearing quantity is going to be 0, but any price at which the order is not executable is going to be a market clearing price, so the prices are not unique. To implement this, one way to do it is to impute the utility function to the linear part of the demand schedule. When you do, you get a quadratic function of X, which is the execution rate on the portfolios. Sum these utility functions across all the orders in the market, and then maximize the utility of that sum, subject to the constraints that say that the orders execute between 0 and Q, which is the way they're supposed to execute, and subject to market clearing. So we have the quadratic optimization problem in linear equality constraints. If they're in assets, it'd be like 1,000 or 5,000 assets. 2I inequality constraints, there might be 1 million orders, so there are 2 million constraints here. But it's got a nice structure for proving existence and uniqueness. Even the matrix is actually, the quadratic component is actually diagonal, so it's a very simplistic problem. So we have a theorem that says there is existence and uniqueness of optimal quantities for the reasons I just stated. That's theorem 1. We can set up a Lagrangian, and we can set up the dual problem that I'm not going to go into, but I'm just going to say that instead of choosing quantities to maximize the utility, the sum of utilities, we're going to be choosing prices to minimize a kind of loss function that we can think of the exchange as having. We can say that if the exchange can't find market clearing prices and has to trade the quantity that doesn't clear, the exchange suffers a loss. The exchange wants to minimize that loss. The minimum turns out to make the loss 0 because you can find a market clearing price. And that's the way the dual problem should be thought about. And that leads to theorem 2, that do exist market clearing prices. And these market clearing prices are not necessarily unique. But again, it's a property of these assumptions, concavity. The finite solution here is useful. The concave function is bounded from above, feasibility, no trade is feasible, and linear constraints. All this are standard results in convex programming. So, our approach is similar to the way that economists have thought about this. Von Neumann thought about it a long time ago as a game. You could think of it as a game played between the exchange and the traders. But it sets up a quadratic program that captures the flavor of that game, and the exchange is trying to set prices that clear the market, which will minimize its losses. The traders are trying to maximize their utility, and the solution to this is our equilibrium. But the approach that economists have taken, either in general equilibrium theory, they've used fixed point problems, fixed point theorems like Kakutani or Brouwer's fixed point theorems, or they have used put constraints on the economic problem that imply compactness or make things easy to analyze. Our approach is a little bit different. We just turn it into a quadratic problem. So since it's a quadratic problem with linear constraints, we can write down necessary and sufficient conditions. I'm calling that theorem 3 here. And theorem 3 just says there are a whole system of linear a system of equations that, if they are solved, guarantee that you have an equilibrium both for quantities and for prices. And this system respects the constraints. It has Lagrange multipliers lambda and mu that tell the order when the order is either fully or partially executing, that kind of put the price of not being able to go further and execute even more. That respects market clearing. And this is the way to set that up. By the way, you can replace the argmax here with just the first order conditions. Those are linear first order conditions. Okay, there's another way. One way to solve the problem, which I've just been describing, really has been focusing on what's called the primal problem of solving for optimal quantities. But you can also solve for optimal prices. And if you come at it that way, you can think of it as maximizing consumer surplus, or at least all the traders are trying to maximize their consumer surplus. So you can define something called a gains function. And the economic is that it's kind of interpretation of it is that it's the sum of all the consumer surpluses across all the orders in the marketplace. And that consumer surplus is defined essentially the same way it is in an economics class, as a kind of a triangle or trapezoid that's defined by the demand function. And it's related to the demand function. So when you set the problem up this way, you're kind of directly solving the dual problem, but you get the same answer. You get market clearing prices, you get market clearing quantities. The question is whether you want to, which way would you want to do it for computational reasons. So what we think happens in practice is the exchange is going to choose a way to do the computation, and they could choose any number of off-the-shelf quadratic optimizers to try to do the computations. But we think that in practice, you're going to have hundreds or even thousands of, hundreds of thousands of orders, maybe 1 million orders. And you're going to have also a lot of stocks or a lot of assets you're trading, maybe hundreds of stocks or even 1,000 stocks or even more than 1,000 stocks. And so these are not the most gigantic problems that can be solved with computers today, but it's a big enough problem that the challenge is we need to solve it in less than 1 second because we're holding auctions every second. And so the question is whether you can solve a problem like this in less than a second. And the answer is I can solve a problem with hundreds of assets and hundreds of thousands of orders on this laptop computer I'm using for this presentation in about a second. But if I want to solve an order for 1,000 assets or more on my laptop, then it's going to take multiple seconds because it takes longer with more assets. So we think though that if you have an industrial strength optimizer and an exchange that's willing to spend more money than I spend on my laptop, they can solve this in less than a second. So it's something we're working on. It's kind of work in progress, but we think it's quite feasible to implement what we have in mind. Okay, let me finish with a couple of slides and then I'll be done. Just talking about some practical issues. First, so there's some economic policy issues. And if you think about economic efficiency as a goal of, let's say, the U.S. Securities and Exchange Commission. It is a legally mandated goal. Our concept of efficiency is to eliminate the costs associated with bandwidth, speed, communications infrastructure that are kind of zero sum in nature and therefore don't contribute to the efficiency of the economy, but just give one trader a gain at the expense of another. So it's this operational efficiency that we think we are improving quite a bit. What about competition? Policymakers also have a goal of increasing competition. Well, what our approach does is it allows traders without sophisticated technologies to compete on a level playing field with traders who do have sophisticated technologies. And so that means that traders can focus on their alpha models, their market impact models, their risk models, and not focus on speed, bandwidth, and complexity of their order handling systems. Fairness. Not only does our approach level the playing field, but it's fair in some other ways as well that are associated with transparency and trust. And all of these are objectives of a government policy. For transparency, all traders receive the same price at the same time for the same asset. Every order that could be executed at that price gets executed. Unlike current markets where typically you have a bid price and an offer price, and when there's a trade at the bid price, some of the orders get executed at the best bid, but some of them don't. Then there's trust. Not only do all the orders that can be executed at the same price get executed, but the exchange will publish market clearing prices every second. And each trader can look at the history of market clearing prices and verify from that history how much of their order should have executed. And you can't do that in current markets because you don't know when your orders actually execute. So this creates some trust in markets that is otherwise absent. So we think that there's some real advantages this has, but they're all policy advantages in the sense that the regulators in the US at least are mandated to pursue objectives that are more or less what I have in this slide. There's some other issues that come up that are kind of implementation details. You need a tie-breaking rule if prices are not unique. For example, you could choose prices that are close to what their most recent price was. But the way we think it's better to implement the tie-breaking rule is to let the exchange do a little bit of trading on its own account. If the exchange submits an order that provides a little bit of liquidity to every asset, that would be essentially a matrix that's positive or negative semi-definite. Negative semi-definite, if you think of it as a downward sloping demand schedule, could just be diagonal, which would be an order for each asset. Then that actually guarantees unique prices, and it creates a tie-breaking rule by picking a price that has the exchange not doing the trading that it does. So you also need a backup plan for what happens if you cannot compute prices in 1 second. Typically that might happen when, let's say, markets are crashing or huge numbers of orders come in or something like that. And so you'll need a mechanism for dealing with fast market conditions. We haven't exactly figured out what the right mechanism there is, but we've been thinking about it. We need to deal with issues about how much transparency are we going to have pre-trade and post-trade. We think we will probably not allow much pre-trade transparency because the market is always trading at every given second. But we will allow some post-trade transparency. You want to publish the prices at which trades just occurred, and you want to publish the market volume. But you could also potentially publish some information about market depth. How much would an order for 100 shares, 1,000 shares move the price if it were executing, let's say, 1 share per second, 5 shares per second, something like that. We, at this point, don't allow the most complete preference expression that is feasible. And we're thinking about different extensions. For example, VWAP orders would be a different extension. So to conclude, and I'm finishing up a little bit early so we can have some questions. We think we have a simple yet powerful method for expressing preferences, this piecewise linear demand schedules. We're creating incentives for traders to provide liquidity and also demand liquidity over time rather than all at once by having flow trading, which smooths out the demand for liquidity and smooths out the supply of liquidity and doesn't have a lot of instantaneous market depth at any particular nanosecond, what you're doing is you're dramatically getting rid of the perverse incentives for this arms race for speed. We accommodate a lot of the trading strategies that traders actually want to do in the markets, like trade pairs, trade portfolios, and trade gradually. We've got unique market clearing prices that maximize as bid at least social welfare, even though it's not real social welfare because the orders are strategic. Everyone's gets executed in a transparent way at the price at which they traded. And we think it's computationally tractable enough that it will scale to many assets and orders. In fact, we think that the scaling with orders is kind of trivial because orders can be parallelized in the computation. Scaling with assets is the more difficult problem. So let me stop here and leave a little time for questions or give the other speakers a little more time.
Pete, let me maybe ask you a question about high frequency trading. So high frequency trading is initially discussed quite a lot, and there are a lot of discussions that high frequency traders impose some sort of tax on long-term investors, institutional traders. So can you maybe explain a bit more how your design would help to deal with this issue?
Okay, so let's
think on some particular examples. So
yeah, I'll give you an example. Let's take the example. I think it was slide 1. You want to buy 1,000 shares of some stock. Say it's Apple. The price is, let's say, let me just go right back to the beginning and let the price be what I use there. $126.85. Maybe the bid-ask spread is bid at 126.85, offered at 126.86. Apple typically trades on a 1 penny bid-ask spread because it's very actively traded and very liquid. So now let's suppose a piece of information arrives into the market that's very relevant for Apple. There's a lawsuit filed, or the CEO is injured, or some scandal is uncovered, and there's a press release. And all of a sudden, the price changes from $126.85 to $126. So it's an 85-cent decline in prices. I'll want to cancel my buy order because I don't want to pay 85 cents more than Apple should be trading at. But the high-frequency traders will want to hit my buy order to trade with me, force me to buy at $126.85. So I am probably going to lose that race. And as a result, the high-frequency trader is going to make 85 cents per share on 1,000 shares, which is $850. I'm going to lose $850. So that's a big example of it. Those examples don't happen all the time, but there are many small examples. And this would be an example where another stock that's related to Apple, say Microsoft, falls by a few cents in price. And the high-frequency traders use that as information to think about where Apple should be trading. And the answer is, well, it shouldn't be trading at 126.85. It should be trading at 126.83 or 84. And so they hit my order, and they, instead of making 85 cents per share, they make 1 cent per share. Well, 1 cent per share times 1,000 shares is $10. Now, what happens in our design? In our design, the maximum rate at which I'm buying is Q, and Q might be 1 share per second. So, and that means it's 1/10 of a share per 100 milliseconds, or a 100th of a share per 10 milliseconds. So if it takes me a full second to cancel my order, and if other traders in the market are as slow as I am, it takes them a full second to react, then yeah, I'll lose my penny, but I'll lose the penny, the 1 cent per share, on only 1 share, not on 1,000 shares. In fact, markets react more quickly than that, and they react in sometimes in microseconds, or even milliseconds or nanoseconds. So the loss might be a penny on a small fraction of a share. So we're talking about, instead of losing $10, losing a small fraction of 1 penny. And the reason is that, yes, your order will get picked off, but it will only get picked off for the flow quantities that are actually available for trade during the time the market is reacting. And those flow quantities are going to be large over a very long period of time, but small over a short period of time. But markets react quickly. And so since the market reacts quickly, it will reduce your losses to zero in our design, but won't reduce your losses at all in the current market design, because whoever's the quickest gets the whole trade, regardless of how fast they are.
Pete, I'll ask you the next question. There's a question from one of the participants about the role of cash in your trading system. So do you have any, are there any restrictions? For example, should you have cash as one of the legs in your transaction, or you can, for example, have something like a swap of one asset into another, or
actually,
cash should be in one of the sides for sure.
Yeah, that is a very good question. And the answer is that implicitly, we do have cash as the kind of residual asset. And so the price that you pay for the portfolio is essentially the amount of cash that you'll be exchanging for the various assets in the portfolio. So, in order to just buy a stock, you're paying cash to buy the stock. So you're exchanging cash for stock, and the order specifies how much cash you exchange for how much stock. If it's a pairs trade, most of what's going on in the pairs trade probably is the value of the stock that you're buying is canceling out against the cash with the opposite sign of the stock that you're selling, but there is a residual that could represent how much you pay. And that residual is captured by the value of the portfolio, but the value of the portfolio might be very close to zero because you've ratioed the stocks by the quantities that you buy and the quantities that you sell have approximately the same market value. So the cash cancels out. So what you could do here is enter orders if you wanted to, so that the market clearing price of the portfolio you trade is almost always very close to zero. It's not going to be exactly zero because there's a gap between pH and PL. Those are the values of the portfolio. But there's nothing wrong with pH being above zero and PL being below zero, and both of them being rather close to zero. So I could, for example, if I didn't want to exchange my assets for cash, but I wanted to exchange them for, if let's say a bond fund was traded as an ETF on the stock exchange, I could just trade my stocks for this bond fund and do everything that way. Now, there would be an extension where everything would be swapped for without cash, but that would be an extension to our design. I think it's a fairly modest extension.
We have more questions. Maybe 1 more minute for questions about, and then we'll go to the next talk. The question, are there any obstacles that may prevent this optimal market design from replacing the traditional one? And from myself, how would you see this process happening,
okay, there's
from the current structure to this idea.
Right. I understand. This is an issue I could spend like another hour talking about, but I'll give you the short answer. The short answer is there are 2 obstacles. One obstacle is the way securities markets are regulated. Does our proposal fit with, let's say, SEC regulations for how an exchange should work? And the answer is it doesn't exactly fit with the current regulatory structure, because the current regulatory structure has bids and offers being posted in increments of 100 shares and price increments of 1 penny. So you would need to kind of change the regulations a bit if we were going to implement this as an exchange. On the other hand, if you implement it as what is called a dark pool, it can be implemented in a pretty straightforward way as a dark pool, because dark pools can trade small quantities and dark pools can trade prices without posting spreads in 100 share and penny increments. So that's the regulatory answer. Then there's the competitive answer. And the competitive answer is that if one operator introduced this, let's say through a dark pool, and started competing with all of the exchanges out there, how would the competition play out? And we think the answer is they would have a hard time picking off the orders on the flow exchange, because the flow exchange is structured in a way that is very difficult to pick off the orders. but the flow exchange is structured in a way that it's very easy to do arbitrage orders on the exchange, and the same traders that cannot pick off the flow orders. If you're coming from the flow exchange, you can still pick off the orders on the other exchanges because they use an imperfect market design. So we think that the other exchanges would be kind of less competitive than a flow exchange once a flow exchange got up and running and had customers. Now, a lot of the benefits of flow trading will not be realized until the flow exchange has a really large market share. So, you know, in the long run, what I think should happen is the flow exchange should compete with the other exchanges to a point where the flow exchange has the vast majority of the market share, but the other exchanges are still there providing a competitive threat. At that point, you get the big advantages of flow trading coming through having a centralized exchange. So I know this conference is about decentralized markets, but we think that when it comes to an exchange, centralization might be better, even if decentralization is better in other respects.
So let's postpone a little bit this discussion. Hopefully we'll have some time at the end of our session. We have more questions, Pete, for you. So maybe we'll combine everything at the very end. So okay, let me now introduce our second speaker, James Glattfelder, who is a researcher at flovtec, a Swiss company which designs some market-making solutions for digital asset exchanges and token issues. So James is very much interested in decentralized technologies and ecosystems that evolve around those technologies. And he wrote a number of books on this topic. James has a technical background and PhD in the study of complex systems. And he will talk about decentralization now as the way to make systems more resilient and more robust. So maybe we can later discuss also a little bit which systems are more robust, decentralized or centralized. So please, James, you'll have about 25 minutes.
Thank you very much.
See your slides perfectly.
And can you hear me?
Yes.
Amazing. Give me 1 second, please, to... Okay, so...
but now we have black screen.
Now you have a black screen. That is interesting. So
maybe I can reduce the size back. Yes, now it works. Let's do it this way.
So that's interesting. I shouldn't go full screen on my laptop. Okay, so hello, everyone. Yeah, today's session is called Resilient Markets and Decentralized Finance. So the question is, well, is decentralization really a good blueprint for resilience? So kind of to find out in the next 20 minutes or so, I would like to talk a bit about the history of finance, a very brief and idiosyncratic history of finance, but kind of it's a story about discovering uncertainty and randomness and how we kind of understand this. And then I would like to give a kind of a take from the study on complex systems. So what do we actually know about resilience and self-organization and emergence and phenomena like that? And finally, what is decentralized finance and why should we actually care? Okay, so in 1776, Adam Smith kicked off kind of the modern version of economics with his influential book on the wealth of nations. This was actually inspired by Isaac Newton's mathematical principles of natural philosophy. And Smith talked about this idea of having this kind of magical hand which orchestrates and guides markets and sort of gets into an ideal state. Then in the year 1900, Max Planck stumbled upon quantum mechanics when he was studying black body radiation. So this really initiated a groundbreaking revolution because it kind of changed the fabric of reality. So this old notion of a clockwork universe died, and we found kind of randomness at the very core of reality. And in the same year, Louis Bachelier presented his PhD thesis, where he used a stochastic process to model price changes. Now, the term stochastic refers to kind of the formal way to model phenomena which are random. Then the year 1905 was a very successful year for Albert Einstein. So he published 4 papers. One was on the photoelectric effect. This would actually help pave the way for quantum mechanics, and this would actually win him the Nobel Prize. So he did not win a Nobel Prize because of his theories on relativity. And this was the second paper he published that year on special relativity, and then on his famous equation E equals mc squared. The fourth paper was not so well known, and it's about Brownian motion. Now, this is the random motion of particles suspended in a fluid, and this was first studied by the botanist Robert Brown. So Einstein showed with his work that basically, well, he gave the empirical evidence that atoms exist, which at the time was still a debated notion. And what this work also introduced was a new paradigm, namely the stochastic modeling of natural phenomena. And then between the year 1906 and 1931, there was a lot of formal work done. Andrei Markov introduced the prototypical statistical process. This is still named after him to this day. And then we had the Langevin equation and the Fokker-Planck equation being derived. Both of these describe stochastic systems. Now, a breakthrough happened in 1942 when Kiyoshi Ito presented the mathematical foundations for randomness, stochastic calculus. And in the 1950s, Paul Samuelson modeled stock markets using Brownian motion. So kind of the forgotten work of Bachelier reemerged here. And Samuelson would go on to win a Nobel Prize in economics, which actually is not a Nobel Prize, it's a Nobel Memorial Prize in economic sciences. Then in 1963, there was another breakthrough when Benoit Mandelbrot discovered the self-similar nature in financial time series. So this would inspire the notion of fractal geometry and lead to nonlinear dynamics and eventually chaos theory. Then in the year 1973, Fisher-Black and Myron-Scholes introduced their famous equation on options pricing using stochastic calculus. And then in the year 1993, the US House of Representatives voted to stop the construction of the superconducting supercollider. This was a particle accelerator that was being built in Texas. And actually, if finished, it would have been 3 times bigger than the LHC at CERN. But as a result, a lot of theoretical physicists lost their jobs and they flocked to Wall Street. And this is kind of when the quantitative analyst or the quant was born. Then in 1998, we had the hedge fund long-term capital management collapse and it had to be bailed out. Myron-Scholes was also involved in this company. And then the year 2000 saw the burst of the dot-com bubble. And 8 years later, we have the global financial crisis, followed by the sovereign debt crisis. So finally, in the year 2009, Satoshi Nakamoto, whoever that is, launched the Bitcoin blockchain. Now there in the Genesis block, there's a reference to a newspaper article which talks about bank bailouts. So people think this is a commentary on financial instability and actually the motivation for developing Bitcoin. So what do we learn from kind of all of these things? Well, financial systems are not resilient. And despite all this clever math that we throw at them, this is kind of remarkable. And I would argue that there's actually a good reason for this, and it's actually a bad design pattern. So we humans love to organize in pyramids of power, where you have a king and a queen or a CEO sitting on top, and kind of the power flows through the hierarchies in the structure. Now, while this may seem like a very natural way to organize in tribal societies, it's kind of a question if in today's modern, interconnected and complex world, this is still kind of the right design pattern to deal with the modern problems we're facing. So what can we learn from nature? How does nature deal with complexity? Well, the term complexity science is kind of a loose collection of different approaches trying to figure this out since the turn of the millennium. Basically, this was driven by the discovery of scale-free and small world networks. Now, these are networks which are highly structured and very different to random networks. And these were found everywhere across nature. So, in a nutshell, complex systems are comprised of many interacting agents. So this means that the focus shifts away from analyzing the things themselves to analyzing the pattern of interaction of these things. As an example, if you're studying consciousness, it doesn't really help if you start to analyze one single neuron. You're actually interested in the neural network. So this way of doing things introduced a new paradigm in physics, biology, computer science, sociology, and slowly now also in finance and economics. One phenomenon is called emergence. This is when the whole is literally more than the sum of its parts. So the system suddenly starts to show a behavior which you cannot understand and explain by understanding the behavior of the individual parts. And then we have self-organization. So it really appears that there's this fundamental force in the universe which is driving it to ever higher levels of structure formation. This kind of sounds like a teleological force, that is to say, a purpose-driven force. Now, ideas like that get you into trouble as a physicist, and they're usually left to the philosophers. Complex systems are also described by very specific statistical properties. So whereas fundamental systems usually are described by a Gaussian distribution or bell curve, we see scaling law distributions in all these complex systems. And a formal tool to deal with complex systems are networks. So basically you map the things to the nodes in the network, and the interaction pattern is now given by the links. And once you have your network, it's easy to encode this as a matrix, and then you can start to do the math. And perhaps the most baffling observation or insight that came from all of this is that complex behavior stems from simple rules. Now, this may kind of sound trivial today, but actually no one really saw this coming, because people used to think that, well, simple rules result in simple behavior, and basically that complexity is, well, just complicated. And complex systems often show traits of collective intelligence, that is, behavior that is adaptive, resilient, and sustainable. So let's take an example from nature, swarming. So this happens when a collection of individuals starts to behave as one single superorganism. And the key characteristic there is decentralized decision-making. So there's not one single individual in this swarming population that gets to dictate or orchestrate the behavior. All the individuals are basically just tracking what their neighbors are doing and reacting to how the neighbors are reacting. This allows us to devise algorithms, and we can actually start to describe this behavior using computer models. This is what the field of agent-based modeling does. So now, instead of having a bunch of equations which you try and solve, which is usually impossible for complex systems, you can actually start to simulate the evolution of the system and start to understand the properties that way. Okay, to summarize. So on the one hand, we have nature's decentralized organizational pattern. And on the other hand, we have our human pyramids of power. While one is bottom-up and decentralized, the other is top-down and centralized. Now, it's interesting that all natural systems have feedback loops. This means they're highly nonlinear and very dynamic. This is in contrast to most human systems, which are linear and rigid. So while one design pattern can give us glimpses of collective intelligence, the other one can lead to systemic failures happening. But we are slowly moving towards decentralization. So between the year 1985 and 2015, we saw two incarnations of the internet. So first we had the Internet of Information, where we all sent us emails. And then we had the Internet of Services, where we started to buy stuff online. And since 2015, we have the Internet of Value. This is thanks to decentralized ledger technology, blockchains in a nutshell. And then since 2020, we have the emergence of decentralized finance. So what exactly is DeFi? Well, in a nutshell, it's a movement to build a new financial system that is open, trustless, permissionless, and has no intermediaries. It heavily relies on the use of decentralized ledger technology and smart contracts. So currently, DeFi is being built on the Ethereum blockchain using the Turing-complete computer programming language called Solidity. And another fundamental building block is the ERC20 token standard. So looking a bit at this recent history, in 2015, Ethereum emerged. Then in 2018, the decentralized exchange Uniswap was launched. So while centralized exchanges are described by order books and market makers, decentralized exchanges rely on liquidity pools and automatic market makers. This is basically software. Then in early 2020, Yearn Finance entered the scene and people started to take notice. Basically, the reason was that their Wi-Fi token, which was trading at $6, suddenly exploded and 2 months later was trading at over $30,000. And then we had the DeFi summer of 2020. Now, this was weirdly associated with food tokens for some reason. We had sushi and kimchi and hot dog and pasta, but the metrics are pretty impressive. So the monthly volume traded at Uniswap went from 170 million in April to 15 billion in September. And the total value locked in DeFi went from 80 million, 800 million to 10 billion in the same time period. So is decentralized finance really better than our traditional centralized finance? Okay, so let's take a look. Finance has a documented history of greed and fraud. Let's hope that DeFi's way of collaborating and governance kind of can treat these moral hazards, and we will see less of these things happening in future. And finance has sometimes been very ideological. So sometimes equations and abstract beauty are more important than empirical data, or strong assumptions are being made about human nature, which can be shown that some of them are wrong. And we also have prominent economists who's on record saying in 2009 that actually, well, financial bubbles don't really exist. So we'll see what happens with DeFi, and maybe this will be a bit less ideological and more open-minded. And I hope to have convinced you that centralization is a bad blueprint to deal with complexity. So decentralized networks are the way to go. And finance has been criticized for being inefficient and non-transparent. So this is one of the key value propositions of DeFi, where we have efficiency and transparency by design. And finance has been plagued by proprietary technology and legacy issue. This one story always comes to mind that someone once told me, where this 70-year-plus software engineer had to keep going back to the bank where he used to work at every couple of months to maintain a system that was programmed and running in COBOL. On the other hand, DeFi gives us open source projects. This means that anyone can download and participate. And finance has also been criticized to create inequality and have high barriers to entry. Again, this is one of the core value propositions of DeFi, to create a more even playing field. And for some reason, no one can really predict and prevent financial crisis from happening. So let's really hope that this new blueprint, which DeFi is using, can show us also glimpses of collective intelligence, like resilience, adaptivity, and sustainability. So we're really at the threshold of a new era where we could see the democratization of finance and resilient markets, but there are still a couple of hurdles to be taken. So everything is software, which means bugs in smart contracts and hacks are a major threat. Then we've had dogmatic things like code is law, even in the face of software bugs. This has led to in-group fighting and disruptions in communities. And on the technical side, scalability is a big issue. But although there's like a lot of very promising and interesting solutions being presented, we still don't really know how this pans out and if we really can get the throughput that we need. And overall, we have no idea how the regulators will react to all of these new developments. And as more and more blockchains keep emerging, one of the next issues to tackle will be interoperability and cross-chain liquidity. And overall, the question is, can we humans really resist the temptation of centralized organization? So Adam Smith was right, but in a very unexpected way. So there is this magical hand which can guide markets, which can lead them to self-correcting and resilient behavior. But Smith was very wrong about the mechanisms that lead to this. The unrestrained self-interest of humans does definitely not lead to collective intelligence. The best guess we have is that it's decentralization, nature's blueprint for resilience. Thank you very much.
Thank you very much, James, for this nice philosophical thoughts on the subject. I suggest let's go to the next speaker, and then we'll have some time for discussion and questions to all of our speakers. So Anton, our next speaker will be Anton Bukov, and he will also talk about decentralized finance. Anton has been involved into software development for many, many years, and he has a number of very successful startups. And then, Anton, I hope that you will share with us your perspective on these issues and maybe some stories about your new projects, 1inch and Uniswap. Please.
Yeah. Hi, everyone. My name is Anton Bukov. I'm currently co-founder and CTO of 1inch Exchange. You might be heard of it. It's a DEX aggregator. I have over 20 years of software development experience, and for like last 4 years, I'm mostly concerned on smart contracts and blockchain related development. I'm gonna share my slides now. Yeah, can you see?
Yes, everything is good. And let me use this 3 seconds to encourage everybody to send questions so that we can ask them our very good speakers at the end.
Okay. Yeah, I'm gonna share some slides with you with, I call it DEX story. It's a story about DEXs, how they appeared in historical order, and what are their key differences, and what is like the most inspiring behind each of them. I saw previous speakers named some of them. I will provide like a little bit more technical details about their differences and why these projects are so interesting. So let's start. My presentation have several main points. Initial DEXs which appeared on blockchains were order book based, similar to approach in traditional finance. Later in 2018, we saw first liquidity based DEXs. We also call them AMM, automated market makers. And this also led to impermanent loss thing. It's only applicable to AMMs. And at the end, I will tell about aggregation, how it works, and what are benefits of it, upsides, downsides. So, but I will start from super simple ideas how order book based DEXs works. So
initially, it was in traditional finance for sure that there are like two kinds of users who want to buy and sell some asset. And when demand meets supply on concrete price in time and concrete DEX, exchange happens. But there are two different entities, limit orders and market orders. And we call those who create limit orders, we call them makers. Those who do market orders, we call them takers. You can create limit order for selling for exact price and wait until someone will come and fill it. Those who will come and fill it is a taker who execute market order. They execute these orders with not like exact price. They could have a price slippage because they can fill different limit orders with different prices. For example, if they wanna buy or sell huge amount, it will be executed immediately, but they will have potentially some slippage. Some orders will be executed on best price, some order will be executed with a little bit worse price. So that's how it works. I will also use these two words on-chain and off-chain because I needed to describe you how different DEXs differs from each other. On-chain availability means that data is available for smart contract. You can execute some smart contract, and this smart contract is able to on-chain all necessary data, and all this data is called on-chain. And off-chain is some data which smart contracts can't access without your help, without user help, decentralized application help, which performs calls to this smart contract. Off-chain data usually contains some kind of cryptographic proofs, which smart contracts could verify. And you can bring this data in arguments. When you call smart contract, you can bring this off-chain data to it. So initially, like chronologically, DEXs appeared, like first one was Ether Delta. It was on-chain, but orders were not accessible on-chain. Later, more advanced version of this protocol appeared with name 0x protocol. It had like two different versions, or version with relays where you can run your own relay, which works as a server, which can keep some orders and share among own users. And also another way to use it was 0x Mesh, which appeared like much later. It's like peer-to-peer network where servers can exchange different orders, and anyone can create any order permissionless, like for any token, even not listed. And how it works, that those who wanna be a maker, wanna create limit order, it only creates off-chain order by creating cryptographical signature. And if taker wanna fill this order, takers will bring this signed order to smart contracts. Smart contracts will verify this signature and be sure that this concrete user wanna sell this concrete asset with this exact price, and also this order is valid till some timestamp. And if everything is fine, 0x would allow you to fill this order. Also, one more interesting protocol appeared called AirSwap. It works similar way, but do not allow you partially fill orders, and it do not support sharing of different orders. you should just query what you want to buy or sell, and you will get exact order for exact amount you want to trade. It allows them to hide their order books, because you can't see any order books. Actually, you can just query, like make a request for quote, and they will give you a quote for which is valid for a few minutes. And one more DEX was Oasis.app by MakerDAO. It's different from all listed above because it manages ordered list of orders. So it's actually storing order book on chain. And this allows them to execute market orders on chain without any arguments, without any orders which you should bring off chain from off chain. So you can visualize order books as a market depth chart for sure, to see like all these volumes and all these orders. And yeah, to summarize this thing as order book based exchanges, it's pretty simple. It has some implementation differences, which like off-chain or on-chain order storing, and on the general part, it's like almost the same what we had on traditional finance, on centralized exchanges, on everything that we saw before. But the next part is more interesting. I'm going to tell you about liquidity-based decentralized exchanges, which allows you to remove maker from this trading relationship. So these DEXs do not need any external makers. They are makers on their own. That's why they're also called automated market makers, because they're makers. And this means that if you're going to trade with them, you can always do that. If you see like one of the AMM with like two tokens, like for example, it's Ether and USDC, you can buy and sell Ether for USDC. You can buy, sell USDC for Ether, but the exchange rate which you will be given will depend on different formulas implemented inside these AMMs. But this is like a really cool idea that you will have always liquidity and you can trade with it. So the first liquidity-based DEX was Banker Network. And the core idea was to have different smart contracts for each pool, and each pool will have two assets, like their own BNT asset and any other asset. And having this star architecture allows you to swap any token to any using token in the middle, token BNT. On this picture, you can swap DAI to BNT and then BNT to Ether. It's like two swaps, but you can perform this exchange in single transaction. The next AMM appeared was Uniswap. It have a pretty more optimized formula, more lightweight formula. It's so simple as multiplication of two different balances should be equal to constant. Just imagine smart contract have on its own balance two assets, Ether and MKR, as on picture. And if you will bring some amount of Ether, it will decide how much MKR it should give you back to keep this equation constant, multiplication of own balances. And this means this AMM do not need any external source of price. And if prices changes externally, this means this AMM is not aware of these changes. and you can trade with it and buy something cheaper than it should be. Yes, that's correct. But when you will trade with it, you will change balances and you will change actual price on it. So you will help to rebalance this thing. So how it works, that actually worth of Ether and worth of MKR, they are equal, and balances, they are moving on a curve, which is XY is equal to constant. So on this image, you could see like balances are changing. Balance of first token change it from A to C, and balance from second token change it from B to D. This is like how swap happens, like C minus A change it for B minus D. And this allows AMM, if you look on this chart, you can see that you can't drain any of its balances. You will always have something on the balance. And this allows Uniswap to trade in any range of prices. Prices can dump 1 million times, can pump 1 million times, no matter in which direction, but it will always be able to trade with users. The next thing appeared, it was in 2020, pretty recently. It was balancer.finance. In 2021, they also launched Balancer 2.0, and they found a better formula. It's like multi-dimensional Uniswap, because Uniswap is, if you are a liquidity provider, it works as a automatically rebalancing portfolio of two assets where weights of your portfolio are equal, like 1-to-1. But on Balancer, you can set up your own pool with different tokens with different proportions. And formula is almost the same. I mean, Uniswap formula is just a case from Balancer formula, that multiplication of balances in the powers of weights should be kept constant. And the interesting thing that both formulas of Uniswap and Balancer, they were introduced in 2017 by Alan Lu from Gnosis. But yeah, it took some time to implement them, to understand them. And one more interesting thing launched in 2020 was Curve.finance, CurveFi. It behaves as AMM, but formula is different. The formula, I can describe it as it's AMM designed for stable tokens of same asset. For example, it could be stable tokens of USD, like USDT, USDC, DAI, etc. It could be stable tokens to Bitcoin, like Rapid BTC, REN BTC, PBTC, TBTC, HBTC. There are like number of stable tokens to external assets. And this AMM allows you to trade these assets with better prices than on Uniswap. This means that when it seems like almost balanced, that all the balances are almost equal, the swap fee is pretty small, slippage is pretty small. You can see this on this chart. And it behaves as a formula with constant fee. But the more you imbalance the pool, the more this formula will look like Uniswap formula. So it's like gradually changing formula from linear to Uniswap-like constant product formula. Yeah, and the thing which appeared when we came up to these AMMs is impermanent loss. How we can simply describe this, what is impermanent loss, is that if you have two assets on this pool, and if you have two assets on your wallet, which are like just laying without any movement, what will your balance experience if these two tokens will change their prices? If both tokens will pump or dump, you will just have the same as if you just holding these two tokens on the wallet. But if their relative price is changing, you will have impermanent loss. And it makes no sense like how much price were different in the middle of your liquidity provision. When you start providing liquidity, there was some exact price, relative price of these two assets. And when you will decide to withdraw your liquidity, there is some price of relative price of these two assets. And if it's not the same, you will have impermanent loss. But you can avoid impermanent loss if you will wait till a relative price will be the same. So if, for example, you can see that you have two assets and one of the assets like increased in price 2 times and another asset dropped in price by 10%, you can compute like how your portfolio moved, and then you should also compute how relative price changed of these two assets, and you should compute how much impermanent loss you will have. So impermanent loss is the thing which is how your liquidity in AMM is different from liquidity on the wallet because of using this Uniswap like constant product formula. Sounds complicated, but actually it's not very complicated and not like a super huge issue. You see, it's like if one of the assets price changed 4 times, for example, if one of the assets is USD and another asset is Ether, and we see 4 times price increase on Ether, half of your deposit increased 4 times. This means that you will have 2.5 access on whole your deposit, and you also should apply 20% impermanent loss. So it's like you will have 2 access instead of 2.5 access on your whole deposit. So that's how we can compute it easily. Yeah. So this impermanent loss, if you like did not understand it, it's not actually your problem, because almost no one in DeFi understand it. Those who are most concerned about impermanent loss, they think that it's like very huge numbers, but actually not. Okay. The next topic I'm going to describe is aggregation. We actually, with my co-founder in 2019, in May, on ETH New York Hackathon, we came up to idea of aggregation that we found out that to make swaps on DEXs, we were made to check prices on 3 different DEXs. I remember it was Uniswap, Kyber, and Banker. And even if you're swapping few $100, we like could notice that selecting a proper exchange for a concrete token could give you like $10 difference. And when you swap $200, you have $10 difference. It's huge. And we found out that all these DEXs, they are permissionless. We can build a website to get all these prices and also to create transactions to all these DEXs. And then right on the hackathon, we came up that the more you swap on each DEX, the worse is the rate. It should not be different, actually. And if you would swap less amount on each DEX, price could be improved. So actually, the basic idea is that you can easily select best DEX with best prices. But actually, what we built on Hackathon was that we can distribute user volume among different DEXs to improve prices. The less you swap on each DEX, the better is the rate. So you could actually benefit by splitting your volume among different DEXs. But you should also take gas costs into account. This means that the more complex transaction you execute, the more it will cost for you. So this is also matters. And we have also a visualization of how we did this. It was dynamic algorithm, but the core idea was that there are different DEXs, they have different liquidity. And access to this would also remove arbitrage opportunities after you swap, because usually when you swap on a single DEX and it's a huge amount of money,
It seems that we have some technical issues now. And I can see that Anton disappeared. Anton, are you back with us? I don't hear Anton. I can see him, but I don't hear him. So, Anton, are you back?
yes. Yeah, I'm here.
You just fell into a black hole.
Yes. So, sorry about this. I don't have internet at home yet. Right now I'm on mobile internet, and they forced me to extend each gigabyte after I will have less than 200 megabytes.
Okay, but now you're back, so please continue.
Yeah. Sorry about this. I will stop it on this slide. Yeah.
Yes.
Yeah, cool. So yeah, we came up to idea that we can exchange on all these DEXs simultaneously in single transaction, and we can shift price to the same value. And this means that there will be no arbitrage opportunity at the end of your swap, because if you swap on single DEX, you create arbitrage opportunity, and you like losing money to arbitrage traders. And what we got after like one and a half year of aggregators on DeFi space, we see that aggregators, they united all these small layer 1 DEXs into single huge high liquid DEX. And a lot of layer 2 solutions, they were discontinued because they are like fighting for their liquidity for their users on their own, and they do not have this composability feature, which is like, I think it's the main feature of DeFi, composability, which allows different projects to interact with each other. That's how aggregators interact with all the DEXs. And for example, 1inch adds every DEX which is accessible. Like, we do not need any audits, because 1inch main smart contract is a security layer for aggregator users. And this means that when we see there's a new DEX, we can add it. This may take 1 or 2 days, but this DEX, if they have a competitive technology, they can get really fair volumes relatively to prices they could offer, and they could start working, because without aggregators, it's pretty hard to attract users to use your contract DEX. Yeah, so sounds a little bit complicated a bit, but I hope it was interesting.
Yeah, thank you very much. So it's actually interesting that we all think about similar issues. Like you talked about this automatic market makers, and in finance and financial economics, we have many papers and many researchers thinking about optimal rules for how to model market makers and what should be optimal strategies of market makers. And Pete is, I have to say, one of the main people doing research in this area, and his famous paper, 1985, or some other papers, exactly about what should be this part of the paper would be also what should be optimal rules for market makers, how market makers should provide liquidity.
Yeah, I saw that some DeFi ideas were borrowed from traditional finance, and we think we should look into it and find more ideas we should borrow, because I'm not sure, like traditional finance have a lot of great papers and a lot of great ideas which were previously not, they were not really applicable, but now it's like a great playground for all these ideas.
So Pete, can you maybe give some ideas about how to model market makers?
It's a very good. Yeah, you can hear me, right?
Yes.
Yeah, it's a very interesting question. It goes back to a paper that by Fisher Black in I think it was 71, when he was envisioning that eventually trading of stocks would become electronic. And he had this idea that the New York Stock Exchange specialist would, which was provided a market making function, which would be turned into software. But it kind of didn't happen that way. And instead, what happened was you got lots of market makers competing with each other. And that's what you have right now. And I think the question of what the optimal way to have market making done, I think it's an open question. You could have a centralized exchange making some markets, or you could have many competing market makers making markets. You could have both at the same time.
Oh, thank you. Anton, can you stop sharing your screen so that we are all on bigger screen? Yeah, that's better. Great. Another question that we were getting, Pete, for you also about price stability. In your in this new design that you propose, would prices be more stable? Like, for example, if you think about the events in March 2020 with this coronavirus crashes, how would your system do in those environments?
So I think that was a more like a bank run where people were dumping fixed income funds, and that was accompanied by a flight to quality. And ultimately, you need for the central bank to get involved there. And that's, I think that's what happened in March of 2020. You also had a lot of dumping of stocks. The stock market collapsed quite a bit, but that I think was precipitated by the dumping of bonds. What our design probably will do, however, is make prices a bit more stable if you average them over, let's say, a minute. But the auction price at each minute is going to have some noise in it. It'll probably have what a lot of people would consider to be a lot of noise. And that's because when people submit bids and offers at these auctions that are held every second, nobody knows what bids and offers other people are submitting. And so prices might jump and then kind of settle back down at the next second. So you'll get probably a lot of negative autocorrelation second per second. But I don't think anyone would care about that because they're executing orders that would persist over longer periods of time, like a minute or an hour. So that'll be 60 or 3,600 different prices that get averaged together. So for those people, prices will be more stable. But I don't think that our proposal addresses the systemic risk events that we've seen.
To finish with your questions that were left from your presentation, another question from the audience, has the proposed approach to market design been empirically tested?
That's a good question.
Evidence?
We've run some simulations, in our own computers, but they're very preliminary right now. And we don't know of any actual exchanges that work like this, although there are orders that work like what we have in mind, like VWAP orders that are similar, or TWAP orders, where traders try to trade a price that's averaged over time.
So let me maybe pose a question a tricky question for everybody. So the theme of this conference, most of the conference is essentially about how to make everything decentralized, because there's a lot of disbelief or mistrust or all sorts of central planning or centralized system. And in economics, in contrary, often centralized systems would appear as optimal structures. So I wonder, are there any ways to somehow reconcile these two big ways of thinking, or there is no way? Because for me, from what I hear, it seems that there is this desire to have some design that will eliminate intermediation, costly intermediation, but somehow the suggestions are completely opposite. One suggestion is that it's better to have everything decentralized, and economists would say more like centralized would be better. So are there any ways to somehow reconcile these two paradigms? That's a question for everybody. Do you see any maybe applications or something?
Yeah, let me start. When I hear this thing about decentralization, initially I was thinking about accessibility and like permissionless access to these services. But the more I diving into this, the more I seeing a different cool feature of I call it composability. It's about how all these services built on blockchain, they could interact with each other. So that's how you can have some lending money market protocols. You could have some leverage protocols. You could have some derivatives, and you could easily change your instruments. You could start with one DApp and you can switch to another DApp. You can have some leverage in one thing, and you can buy some insurance in another software, but it will all be connected to your wallet, to your assets, and some of them even could be tokenized, and you can share part of your debt with your family, I don't know, with your colleague or partner, and it makes all these different DeFi protocols work together with each other. That's what we never saw in traditional finance. If you have some bank, even if it's super cool bank, it could offer you some insurances, it could offer you some investing feature into stocks, but you will not have access to some new cool products until your bank will integrate them. I see it's like one of the strongest benefits on decentralized systems, that they can interact with each other and be composable in permissionless manner.
So any other good thoughts on this?
I'll give you my thoughts. One concept of decentralization I think of that's very important is a customer ought to be able to trade with another customer without incurring a fee associated with an intermediary charging a markup. And one way to implement that actually is with a centralized exchange. But essentially, the centralized exchange is operating as an agency for all the customers, allowing them to trade with one another in a decentralized manner. A lot of times in a dealer market, the dealers don't let the customers trade directly with each other because they want to extract their rents. And it's better to create this level playing field. So the level playing field that allows customers to trade with customers is, to me, the key feature of decentralization.
I would argue that we are actually moving towards this, that's kind of, we're gravitating towards it because of kind of the technological advances, things like the internet connecting everyone, and open source projects where everyone can collaborate are kind of major sort of new forces where kind of these proprietary ways of doing things are seem to be something which maybe, I don't know, we'll see less in future, because it's really about this networked and collaborative effect of sort of designing new things and new systems.
Well, great. Let's continue to discuss these issues after the session. And I'd like to thank everybody for participating and for listening to presentations and discussions also. And let me give a floor to Sergey to make some announcements.
So yeah, thanks a lot to all the speakers. Now we have time for some drinks and some like an online party. You have the link in your chat or also in your YouTube channel, which you can click and go into the Master in Finance room in like the online space, so that we can reconvene there and just have a free flow discussions and continue.
Yeah, we're inviting you to our to some sort of lounge that we created for our program, Masters in Finance program at New Economic School, and you're all welcome to join and explore what we have and to chat.
Yeah, it's better to use your desktops or like laptops from the mobile phone. It will be difficult, but yeah, we're looking forward to see you there.
Yeah, see you there.
Thank you. See you there.
Даша